The election of Donald Trump means to me we're going to have much lower taxes, especially since you have the Senate and the House. So much lower taxes, and you're going to have reduced regulations. That is going to be, in my opinion, is going to delay the inevitable recession. Now, on the other side of that, you're going to have tariffs, which is a one-time spike to inflation. It's not inflation. It's a one-time increase in the cost of goods purchased. And then you have deportations. And if those things happen, you might have a spike in labor costs too, as well as a depressant on the economy. But the biggest depressant on the economy that I see going forward is this inexorable rise in interest rates. I mean, the Fed in their omniscience decided in an emergency move, not trying to elect Kamala Harris, in an emergency move to cut 50 basis points in September. And now all of a sudden they're saying, well, maybe we don't have to cut it all. Maybe we're not in a rush to cut. I really am racking my brains trying to figure out what exactly changed, because the data was strong in September, but they cut by 50 and they cut again in October by 25 basis points. But I think interest rates are going down in the Fed funds rate. I think that's inflationary. Deregulation of banks is very inflationary. You have the king of debt and the lover of a weak dollar coming into power again, correct? And the most important thing I can tell you is that the Treasury's insolvency is a condition that we all should be aware of. And that could spike interest rates very high on the long end of the yield curve. And that could bring this whole thing down. And my model's, myopically focused on that. So yes, the chances are stronger growth. Chances are we're having higher inflation, but you have to keep a keen eye on the functionality and liquidity in the credit markets and the money markets and in long duration bonds. And that's what I'm focused on, because that's the warning sign to everything's going to fall apart, the economy and the market. In other words, if you're a passive 60-40 target date fund, closet indexed, passive indexed, like everybody else is, you could get slaughtered. I don't know when. Could be sometime in the later half of 2025, but you could be slaughtered. Could be sooner than that. But we still have massive asset bubbles in credit and in real estate and in equities. It could get even worse going out in the next couple of quarters. So that has to be reconciled, and it will, and it's going to end very badly. We still have a tremendous amount of debt. The household has a record amount of debt, not as a percentage of GDP. That's come down from 100 to around 70%. But 70% household debt to GDP is very high. We have a record amount of corporate debt. We have things like private credit out there, which didn't even exist before. Trillions of dollars of this stuff. Commercial real estate. These are all things that are affected by higher interest rates, and higher interest rates are going to be a massive depressant to offsetting what I just mentioned, the Trump election. And it could get out of hand. It could spiral out of hand, because these are things that Powell and Susan Collins, who, were data dependent. I just wrote a piece called Driving the Interest Rate Vehicle with Your Feet on the Steering Wheel and Your Eyes on the Rearview Windshield. That's what they're doing. I mean, they're making decisions about interest rates that should be based on a free market. Should be based on a gold standard. They're making decisions looking at data that is lagging and faulty. The data is faulty on what? The labor market. That's how they're making their decisions. In my opinion, we should have a money supply that's dictated by the mine supply of gold. That's the base money supply. You should have a fettered fractional reserve system where you can't go out and just monetize debt willy-nilly, but that's what's going to happen. You're going to have the banking system, both shadow and traditional, FDIC-insured institutions, monetizing trillions of dollars of the federal debt, which is going to be bought by Jerome Powell. He's going to be forced to do it. The average interest rate on U.S. debt is about 3.5% right now. There isn't an interest rate on the yield curve. You go from Fed funds all the way to the 30-year. It's much higher than that. So the interest on the debt, which is already $1 trillion, is going to go much, much higher, because the debt's going higher and the interest paid on that debt is going much higher. We're already paying 20% of interest. That would be 30% today if we had interest rates normalized, if interest rates stayed where they were and we just kept on floating T-bills. So why are interest rates rising? Inflation, insolvency, and illiquidity. That's why you'll never hear Powell or Susan Collins talk about that. That's the real problem. And that's what you have to monitor if you're investing in the stock market. And I am. Then again, I am still not short yet. I'm waiting. Financial conditions continue to ease. Credit spreads remain very tight. And we have the promise of lower taxes, much lower taxes across the board on corporations, on individuals, Social Security, taxes and tips and everything. I mean, you could get a lot of this passed. And deregulation is going to be massive. So you're going to get a big increase in money supply. So inflation is going to be much higher than I thought it was going to, or not that I thought, than what it could have been under a Harris regime. So you got to watch the credit markets, and that's going to lead you to a path of being able to invest responsibly and carefully in this bull market that continues, or to get completely wiped out. This could be a 1987 event. By the way, do you know the total market cap of equities? This is Warren Buffett's favorite indicator. The total market cap of equities as a percentage of the underlying economy in 1987 was October of 87. It was 60%. Do you know what it is today? It's over 200% of GDP. That tells you how incredible the bubble is in equities. And everybody's in it. There's a record amount of investors that own stocks right now. A record amount of household net worth is in the stock market. They're all crowded into the same few stocks. When that unwinds, it could be catastrophic. I mean, in 1987, we lost 23% in one day. That can't happen again. And the reason why it can't happen again is because we have circuit breakers, right? 7% down, we close down for 15 minutes. And then we go down 13%, there's another 15 minutes. And if you close down 20%, we shut the whole thing down. So the operative word here is caution, stay alert, have a model that works and monitors the credit markets, because you still could get slaughtered even though things look okay right now. What has the Fed inculcated to the market since 1987? And we got you back. We will print money very quickly and in humongous proportions. So what does the Fed do? It creates something called Fed credit, right? It's part of the base money supply, it's reserves. And they printed trillions upon trillions after COVID, after the collapse of the global financial crisis. They started this practice in 1987 after the crash. So the base money supply was prior to the GFC. That include everything: the Thai baht crash, Russian crisis, 2001 debacle. The Fed's balance sheet, which is high-powered money, basically representative of high-powered money, represents the base money supply, the building blocks of all monetary aggregates, was $700 billion. That base money supply went to $9 trillion post-COVID. It was $4.5 trillion prior to that. Jerome Powell printed $4.5 trillion for what turned out to be only like a slight decline in GDP. I'll say an exaggerated crisis, a health crisis. Okay, exaggerated. It wasn't nothing. People died, and I feel terrible for them, but it wasn't the end of the world. They've shown a willingness to expand that balance sheet willy-nilly in a nanosecond by trillions of dollars, and they're going to do it again. And who's going to buy all that debt? I mean, where's it going to come from? The Fed is going to create credit, and private banks are going to go out and buy it all. And that's massively inflationary. So it's a tactical trade. I sold gold because gold doesn't like when growth and inflation are accelerating. That is what I expect to happen, because there's other alternatives. You could buy stocks when growth is accelerating. Bond yields are going higher. So that's an alternative. It's competition for money. Gold is real money. But that process could end in an absolute disaster once you get a freeze in the credit markets, and then you could have a wipeout of everything. And then people will be, oh my gosh, we're going back into helicopter money. And I wanted to just button up that point, because from 87, the Fed came to the rescue by printing, like we just talked about, trillions of dollars. Because the problem was what? It was, we had disinflation, we had deflation. We haven't had a problem with inflation since 81. Well, now we've got a problem with inflation. And now we have insolvency in the treasury market. So Wall Street's telling us, well, the Fed has your back. They've inculcated this over and over again. The Fed has your back. In a problem, they will print trillions of dollars. But what if they print trillions of dollars when the problem is, the salient issues are insolvency and inflation? They're going to just make the situation much worse. You could have profoundly negative real interest rates, even though nominal rates are spiking. That's the best environment for gold. So gold likes two things. It likes recessions because nominal rates are falling. Generally, real interest rates are falling. There's less competition for other assets because who wants to buy a house or a stock? And gold loves stagflations, because that's when you have no growth or negative growth and you have high inflation. So how do you keep ahead of inflation in that scenario? You have to buy gold. And that's where I think we're headed in the long term. Inflation has wiped out the middle class. It was responsible for the election of Donald Trump, okay? That was the primary reason, that and probably the weaponization of the Justice Department. But minorities voted for Republicans in droves because their purchasing power has been destroyed. And the fact that inflation is above the Fed's target, rising, you're going the wrong direction. It's actually rising from 2.5% and going higher. And Susan Collins says, well, if you take out like the stuff that you need to live, like energy, food, and shelter, we're good. This is how out of touch they are and how dangerous they are. So protect yourself, get smart,